All right, in exercise 18-11, we have an airplane that is being, excuse me, we have an airplane that is being leased. And the first thing it asks us to do is to classify it as either a finance lease or an operating lease. We are told up here that the company that is leasing the plane, that is the lessor, acquired the plane for $950,000, which is its fair market value. So automatically we know it's not a sales type lease. It's either a financing lease or an operating lease. Okay, so we go down the criteria. The annual rental payments are $190,000 due January 1st of each year, beginning January 1st, 2018. The lease term is 6 years. There is no residual value or a purchase option. The economic life of the asset is 8 years, and the airplane is not specialized in nature. The incremental borrowing rate is 8%. So the first thing we have to do is the classification. So our criteria, number one, does title transfer? No, there's no indication that title transfers at the end of the lease term. Number two on that, is there a bargain purchase option? No, there is no bargain purchase option. Number three, do we own it 75% or more of the fair market value of the lease? And in this case, yes, 6 divided by 8 is exactly 75%. So automatically, this is a capital lease, and since we know that the fair market value and what the lessor paid for it is the same, we know it's not a sales lease. This is a financing lease. Let's go ahead for criteria purposes to do the other two classification items. Number 4 is do we own it? Do we have 90% or more? Is the lease payment, net present value of the lease payments, 90% or more of the fair market value? The lease payments are $190,000. Okay, so we take the $190,000 for 6 years, and we need the present value of an annuity due. And this time we are using an 8%. And I found out why we're getting the rounding errors on these is because they used Excel to do the present value calculations, and you get slightly different numbers, but not dramatically. So 190 times 4.99271. And that's 948,000. $614.9, round that up to 615. Divide that by 950,000. And that just rounds out to basically 1, right? So 100%. And so number 4 is a yes also, right? Because we've got 948,000 is well above 90% of 950,000. Finally, it tells us explicitly there's nothing specialized about this airplane, and so no on that one. All right. So now we have to do the initial journal entry. And so as the leasee, that is going to be right of use asset for $948,615 and lease liability $948,615. Okay, we also are going to make our first cash payment at that time, and so We're going to take off lease liability for $190,000, the lease payment, and we're going to pay cash $190,000. So that takes care of our initial entry. Then on 12/31, and this was 2018, we are going to have our interest expense. Okay, now you can do this with a T account, or you can just do it mathematically. For the T account, we do the lease liability, $948,615. We subtract $190,000. From that, we get a balance of $758,615. So we take the $758,615, and we multiply that times 0.08, 8%, and that gives us $60,689. So our interest expense will be $60,689, and this will be interest payable, $60,689. All right. We also have to do our depreciation. They said there's no residual value on this, and however, let's see. And so our lease term is for 6 years, so we're going to do it. It says here the straight line method. And so we will take that, the full lease value, $948,615. And we divide it by 6. All right, now this is important. The economic life of the asset is 8 years, but our lease term is only 6 years. So we depreciate the lease liability by the 6-year lease term, right? We do not use the economic life. We use the lease term here. And that's kind of an important point on that. And so that will be $158,103. It's $102.50. We'll just round that up. So we've got depreciation expense, and that's going to be 158, 102, 103, and accumulated depreciation 158, 103. All right. I'm going to go ahead and do year 2 also. So I'll move this up. And in year 2, so 2019, we are going to have the lease liability. We'll back into that. We will have the interest payable. We know that, right? That's the $60,689. And we have the amount of cash we're going to pay. That is in the lease agreement, and that's $190,000. So we subtract the $60,689 from $190. And we end up with the lease liability going down by $129,311. So we put that, come back up here to the T account. We put in our $129,311. 311. Our new balance in the lease liability is 629. 304. So now on 12/31, we're going to take the 629,304 we just calculated times 0.08, 8%, gives us 50,344. So our interest expense is 50,344 and interest payable. $50,344. Don't forget that we have to do the depreciation expense, so that will be exactly the same entry as the year before. Depreciation expense 158,103 and accumulated depreciation 158,103. All right, so we just do that each year for the next 4 years. That'll give us our lease payment for each year. All right, now let me go ahead and put the lessor's side of the entries here for a couple of years. We'll use a lot of the same numbers on this. So on the lessor, the lessor is going to have lease receivable, and that will be the same amount, the 948,615, and they're going to have lease revenue 948,615. Okay, at the end of year one, assuming they have the same interest rate, well, they're also going to receive cash. Don't forget that. I'm trying to. Don't you forget it. They're going to receive cash for $190,000, and that will come off the lease receivable for $190,000. All right, very good. Then at the end of year one, let's change this and let's assume that they have a 10% interest rate, just to make things a little bit different. And so we need a T account here. And this is going to be the lease receivable, 948,615. We take off 190,000. And so that becomes the exact same amount that we had for the leasee's side, which is 758,615. Okay, so we take the 758,615, and now we're using a 10% interest rate, so times 0.1 is 75,862. So on 12/31, we will have interest receivable 75,862 and interest revenue. All right. And so now notice, because we're the leasee, it's a capital lease, we do not have a depreciation component here. the lessor, we don't have a depreciation component. So on 1/1 of 19, we're going to have cash comes in. We know that's 190,000. We're going to have interest receivable. That's 75,862. And so the lease receivable on that would be 114, 138 on that. So we put the 114, 138. And so now we come up with a different balance. And so now that would be 644,477. And so we would just continue to do that for the next 5 years. All right. So that concludes exercise 18-11.